now we'll discuss some past paper questions on company accounts tax adjustment. So I will be discussing the tax adjustment related to company final accounts. So we'll start with 2017. Paper, right? So whatever the information given, I will write it. Then there are two methods we can do the tax adjustment. I will explain both the methods. Right? Method 1 and method 2. So method 1, we are using the statement to calculate. So there will be two statements required. One is to calculate the tax expense. Tax expense for the year. Right. Estimated current year tax, estimated current year tax, plus or minus. If it is under provision, we will add, and if it is an over provision, we will deduct. Right? Estimated current year tax plus or minus under over provision. Answer will be tax expense. Then we need to calculate tax payable. So how do you calculate the tax payable? We take the current year tax, estimated current year tax. Then we will add previous year actual tax. Current year tax plus previous year actual tax. Then you will get the total tax payable, total tax. From that, we have to deduct the tax paid. Then the final answer is tax payable. So this is how we do in method 1 calculation of income statement. The amount goes to income statement and the amount goes to statement of financial position. Then in method 2 we are using the ledger accounts. Two ledger accounts. One is provision for taxation account. Right? Then we need tax expense account, tax expense, taxation expense. So provision for taxation account is a payable account which goes to the statement of financial position, this way, SRT. And taxation expenses account, this is your expense, goes to income statement. Right? So we follow 4 steps when it comes to ledger account method. We follow 4 steps. First, you record the opening provision balance. Right? Second step, under over provision. Second step, under over provision. Third step, estimated current year tax. Fourth step, the last step is tax payment. So remember this, then you can answer any question from the company final accounts. Right. So first, as the first question, I'm going to do 2017. The second paper, 2017 A level, from paper 2, question number 1. Right? Company final accounts. I'm going to do the tax adjustment. So, what are the information relevant for the tax? There is a provision for income tax in the trial balance. In the trial balance, there is a provision for tax 1st April 2016, which is 800. So that's the opening balance. Our trial balance is for 31st March 17. Year end is 2017. So this is previous year tax provision. So this year opening balance. And also there is a tax payment given 1900. Tax paid is 1900. Right? So those are the two information given in trial balance in relation to tax. Then if you check the additional information, adjustment number 4. Adjustment number 4 says income tax paid includes 900 paid for previous year. So our tax paid is 1900, right? Out of this 1900, 600 for previous year. That means 1300 is for current year. Income tax paid includes 900 paid for the previous year and the payment made for first 3 quarters of the current year. So this 1300 is for first 3 quarters. This 1300 is for first 3 quarters. Income tax liability of the last quarter of the current year was estimated as 500. So 500 is for the last quarter. 500 is for the last quarter. Now we, using this information, we'll try to find out the tax expense and the tax payable. So if you check the additional information, this is, what is this? This is previous year actual tax. We have provided 800, paid 600. We normally pay the actual tax, right? We have provided 800, but actual tax is 600. So the difference of 200, is it over provision or under provision? You have provided more, therefore this is over provision, provided more. So we calculated the previous year actual tax, previous actual tax is 600. We need that. And we need current year total estimated tax. Total estimated tax current year. That is 1300 paid, 500 we made a provision. So total 1800. Right? If you have these 4 information, you can do the working. Right. So let's start method 1. Estimated current year tax is 1800. Take 1800. Then under over provision, it's a over provision 200. This year tax expense is 1800. Last year we provided more, so that should be deducted. Then tax expense for this year is 1,600. Then how do you calculate the tax payable? Total tax for the current year paid and estimated 1,800. The previous year actual tax is 600. So we need to pay 2,400 total tax. Out of this 2,400, we paid 1,900. So 500 is payable. In another term, previous year actual tax is 600. This year 1,300 paid, 500 is payable. So only this 500 is payable. That is this. So this is method 1. If you are familiar with double entries, do this method. Method 2. Follow the 4 steps. Step number 1. Record the opening balance. Provision for taxation is 800. Opening provision for taxation is 800. Opening provision. Then the second step, under over provision. So here we have an over provision of 200. You have provided more, that should be deducted. You have credited 800, which is payable. Now 800 is not the tax, tax is 600. So debit the over provision 200, and your expense will reduce. Over provision 200. That's the double entry for over provision. Third step, current year estimated total tax, which is 1,800. So that double entry for that. Credit the payable account, the provision account, and the debit expense account 1,800. Finally, fourth step, tax paid. So this is where you have the total payable balance that will be debited. The tax paid cash 1,900. So once you balance this, you get balance carried down, balance brought forward, and the difference in tax expense account is recorded in the income statement. Right? So provision for taxation account, credit side is more, 2,600, 2,600. We get 500 payable. Then here tax expense 1,800. Difference is 1,600. So you can see 1,600 is the expense. So here we have the double entries. Here it's on the statement. Payable is 500. So that is for 2017. Right? So let's try to do another question. I will take 2016. Right? So we'll do 2016. I'm using the same set of accounts. Right, 2016. Right. So in 2016, what we have is second paper, question number 1. We have a trial balance as at 31st March 2016. That's the trial balance. And income tax paid is given. Tax paid. Income tax paid is given 535. And there is no payable balance is given. No provision. Opening balance is sealed. Then additional information. information. Number 10. There you have income tax for the current year is estimated as 500. Estimated current year tax is 500. So this is very simple. There is no opening balance. There is no opening balance. There is no under or provision. So directly you can treat this as a normal expense. So let's say your expense is 500, paid 535. So that means we have paid 35 extra, right? So let's put this into the format. Okay, so estimated current year tax is 500. Estimated current year tax is 500. So we can take it here, both. There is no under over provision. So expense is 500. Very simple. No previous year tax. Therefore total tax is 500. Tax paid is 535. Then you get, this is not tax payable, this will become prepaid tax. Prepaid tax. So prepaid. 500 is the expense, but we paid 535. Right. So we'll put this into the ledger account. Opening balance is 0. There is no opening balance, no under over provision, but you have the current year tax, which is 500, tax 500, provision 500, that is the third step. Then you have the last step, tax paid, cash 535. So if you balance this, you get the 35 balance carried down, balance brought forward is 35, 535. So this is debit side, therefore it's a prepayment. Then tax expense, which goes to income statement, 500, that's your expense. So you can use both the methods, right? So we move on to another question. Let me take 2015. Right. In 2015, second paper, the trial balance trial balance as at 31st March 2015 of Saranga PLC. So now I am doing 2015 A level, 31st March 2015. The trial balance. So what do you have in the trial balance? We have income tax paid for first 3 quarters of the current year. Tax paid first 3 quarters, 90. And there is no opening balance, right? There is no opening balance. Then the additional information, number 11. It has been estimated that the income tax for the current year is 1/3 of the profit before tax. one third of the profit before tax. So since they have not given any opening balance or closing balance, you can use the same method that we used for 2016, right? So where you will get the tax, you need to calculate the profit before tax. Out of the profit before tax, you take one third. So let's assume that profit before tax is 1,000,000. So one third, let's say 900,000, right? Then you take one third is 300. Then tax paid is 990. You will have a payable balance, right? So that is for 2015. So let's move on to another question. 2014. So 2014 also we have tax paid for the first 2 quarters of the current year 290, and it has been estimated that income tax for the current year is one third of the profit before tax. Similar question, right? So nothing to do. You can follow the same method. So let's do 2013. Let's check 2013. So 2013 also a similar question, right? Tax paid for the first 3 quarters of the current year is 50. Tax paid is 50, and it has been estimated that the income tax for the year ending 31st March 2013 is 1/4 of the profit before tax. So you calculate out of profit before tax. Let's say profit before tax is 1 million. You calculate 1/4. Let's say it's 250. Paid 50, right? Then the remaining is payable. 200 is payable, and the tax expense will be 250 out of this 1/4. So those are simple questions. 2012. Right. So in 2012, tax adjustment number 8, 2012. Second paper, question number 1, adjustment number 12, right? So it says it has been estimated that the income tax for the current year, income tax for the year ending 31st March 2012 is 1/3 of the profit before tax. So you just have to calculate 1/3 of the profit before tax, and there is no paid amount. There is no paid amount, therefore the entire 1/3 of profit before tax is payable. So those are the adjustments related to tax, and that's how the examiner checked the taxation adjustment.